Hey gang, Jeff Smith, mortgage banker with Assurance Financial here. As we get near the end of August 2023, most people understand now why interest rates are high, that the Fed is trying to battle inflation and get that back under control. But I think most people don't understand the mechanics that go into that. So in about 2 minutes, I'm going to try to explain that and hopefully give you kind of an idea as to when we might see some relief on this thing, or at least what to look for and how to read the news. So this all goes back to the pandemic. And during the pandemic, everybody was told to stay home, right? Our whole economy should have completely broken, fallen apart. There should have been Armageddon. There should have been rioting in the streets. There wasn't. And a lot of it was because as Americans, we actually kind of pulled up our bootstraps, and a lot of us just did what we needed to do to get by in one way or another. But a lot of it's also because of some of the moves by the Federal Reserve and our U.S. government. And the Federal Reserve, for its case, what it wanted, what it needed to see happening was people spending money. We didn't need people going home and holding their money, not buying anything, because that truly would have broken the economy. So what the Fed did, what tools do they have at their disposal, is they can lower their federal funds rate. What is the federal funds rate? So the Federal Reserve, you can think of it is like a big, huge savings account for the big, huge banks. So the big banks, they make their money off of their money, right? So they make money, they have money and they lend it out and they get paid back in interest. They invest that money. In times of uncertainty, which during the pandemic, especially the beginning days of the pandemic was certainly times of certainty, those big banks like to store their money at the Federal Reserve and just collect the interest, the federal funds rate interest. And that rate is also used by those banks so that they can trade money back and forth to each other. So there is a lot that is based off of that federal funds rate. They know they can always make that amount of money. So everything from car rates, car interest rates, mortgage rates, small business loan rates are based on that base rate. So the Federal Reserve did not want the big banks during the pandemic to store their money there. They wanted that money out in the economy being spent. So they lowered their federal funds rate all the way to 0%. So if you put your money there, essentially you were not making any money on that money. And if you're a bank that's not making any money on the money, then you're not going to be able to pay your employees. So therefore, they forced those banks to take that money instead to lend it out to people. And so all of a sudden, money became very cheap. So mortgage interest rates went down to 3%. Small business loan rates went down. Car loan rates went down. Everything went down. So all of a sudden, people were able to borrow money easily, and they wanted to borrow money. And now they had money to spend, which helped stoke the economy. Now, I'm a big believer in the yin and the yang, and when things go big one way, the pendulum's going to swing back the other way, and that's basically what happened. So all of a sudden, we had all this demand, and all of a sudden, we had people staying at home, so supply was already hard to come by. So we had increased demand and low supply, and so anybody knows the most basic laws of economics, the law of supply and demand and the invisible hand. When demand is high and supply is low, prices are going to go up. And that's what they did, and inflation went up over 9%. So the Federal Reserve is sitting there. Now they see this insane amount of inflation just flying up. What is their tool to do? Their tool is to take that federal funds rate and do the opposite. So it was low so that they could get people to spend money. Well, now they went and raised it up pretty high so that people would then, so interest rates and mortgage rates, interest rates on mortgages, cars, small business loans all went very high. All of a sudden, money became expensive. And so they're trying to get people to not borrow money and trying to get hey, banks, if you're nervous at all, you can store the money here. We'll pay you good rate for it. And basically trying to lessen the supply of money that's out there being spent. And so therefore, laws of supply and demand drops down, supply starts to go up, prices are going to come down. And that's what's happened, quite frankly. They were up at over 9% right now. At last check, inflation was at 3.1%. The Fed's target is 2%. 2% inflation, 2% rise in cost of goods and services throughout the country over a year is seen as a healthy rate. So That's where we're at right now. The Federal Reserve has raised their rate to the highest level in over 20 years. We've got really, really high interest rates. According to Mortgage News Daily, the average 30-year fixed rate is 7.25%, according to Mortgage News Daily's daily rate survey. And right now, we're kind of sitting in a spot where we kind of think the Fed has raised their rate enough and inflation has gotten close to under control. And maybe by the end of this year, we'll start being able to ask the question, when are they going to start lowering that rate and getting things back into a normal range? But if you were wondering, there you go. That's the best I can do. I know it was over 2 minutes. I think I'm at 5.5 minutes. Maybe I'll try to do a 2-minute version later. But I hope that at least sheds some light on the subject. And if you need a mortgage, you want to get pre-approved, you just want to talk about things related to the housing industry, I'd love to talk to you. Jeff Smith at gsmith@assurancemortgage.com. I'll talk to you soon. Have a great week.